will create the knock-on effect that will bring back the private sector investment. And I think that's why, the government is working in a very concentrated manner on 3 or 4 very large projects, initiatives. For instance, they are working on the dedicated freight corridor. They are working on the Sagarmala ports. They are working on bifurcation of the rural feeders in every state. That is the transmission lines. They are working on the Diamond Quadrilateral for the train lines. They are working on the bullet train projects. They are working on smart cities. Now, many of these projects, the government is also lining up multilateral agencies to help them finance those projects alongside of the money that will come in from the government. Now, this is precisely what is needed in order to kickstart the economy. Once these bids get out over there and they are allocated, and if we find that the bid details are proper, I am sure financing will come in. I do not think financing is a problem as long as the project is viable and doable. However, having said that, I can also say that the banking system has indeed learnt its lessons. It will not give money to projects which are not properly conceived. It will not give money to, say, road projects if you do not have 80% contiguous land and all approvals in place. It will not give money only on the piece of a paper saying that you will get approval. Until and unless we see those approvals, money will not come. So I think people are aware of this. Similarly, I think the equity component will also have to be ensured by the people who are bringing in the projects for the banks to be comfortable to lend. So I don't really think it's a question of banks not wanting to lend. It's a question of viable projects coming, corporates having that appetite, and the government, if it is the one that is putting out those projects, making the parameters, or rather the governance conducive enough for banks to have the comfort that if they lend, this is a project that will happen on time and will not lead to further issues down the line.
Any more questions? Anyone else wants to ask a question?
Don't tell me I've answered everything. There's a lady over there.
Sorry. Is there somebody?
So, ma'am, let me take the liberty of asking you a question.
Sure, please go ahead.
Will you have higher provisionings for Q4 than Q3? Higher provisionings, higher NPS?
That's price-sensitive information. I'm sorry, I won't be able to give it to you.
What will be the trend, up or down?
Again, as I said, these are all price-sensitive matters, and there is no way that I'm going to comment on it.
So, in your remarks, you obviously referred to, the so-called policy paralysis. The forest clearances, mining licenses being cancelled and so on as a large cause for the NPA problem. And that is, I think that's well taken. No one can deny that. But to what extent but you also in your speech and also in your remarks, for example, you called for the amendment to the Sapresi Act. Also, I think you made a suggestion that, willful default should be criminalized to some extent. So to what extent have promoters also gamed the system? I mean, is it policy paralysis, is it promoters, is it a combination?
No, I'll tell you something. Every community has its bad apples. Can you tell me that the media doesn't have its bad apples?
Sure.
Every single community has its bad apples. And therefore, enforcement has to be quick, enforcement has to be proper. If you do that, only then society operates in a proper manner. But again, to use a broad brush and say every one of these guys are this, right, I think that is really doing your country and the entire entrepreneur class a disservice. That is not true at all. There are a lot of guys over there who are working day and night, and they have put their skin in the game. They have actually created a lot of employment in this country, not only directly, but even knock-on. And if those entrepreneurs had not taken the risk, many of us who are salary earners wouldn't be earning anything. We haven't taken that risk. They have. They need to be respected for it. However, again, as I said, there are always bad apples in any bunch. And for those bad guys, yes, you should have something that keeps them at bay and prevents them from vitiating the entire atmosphere.
Okay. Thank you, Madam Bhattacharya Bodhi. It was indeed a very thought-provoking discussion, and let me assure you, when Madam Bhattacharya was referring to bad apples in media, she was not looking at me or Bodhi or my colleagues on the right side. She was looking somewhere else, which I don't know where. Thank you very much, both of you.
Thank you. Thank you.
Well, TGIF, thank God it's Friday, but you'll have to wait for 1 more hour because the bar is going to be open in next 60 minutes. But we have a lot of food for thought for you, and how to really convert risk into an opportunity. That is something my next speaker has truly done. 69-year-old self-made billionaire Howard.
We at ET now have redefined business news, and it's now time to redefine budget coverage.
And there's no better time to do so than now, because this is a budget like never before. It's a budget for a new India.
An India that is raring to go, an India that is young and excited and wants to seize the opportunity.
So join us on ET now as we rewrite the rules of the game once again. Budget 2016, time is now.
India is one of the few economies in the world which survived 2001, which survived 2008, which survived 2015. If a budget for the cause of ratings goes in for sheer populism, it's not necessarily the cause of economics or even sounder politics that you are eventually fulfilling. We concentrate on infrastructure, we concentrate on irrigation, we concentrate on improving on our agricultural productivity, improving our manufacturing sector. And at the end of the day, what is it that you are asking for to get that cutting edge? That you must grow at a rate which is 1.5% faster than what you are going to.
But it's a crash. Corporates are anxious.
It is a bit disappointing.
Investors are restless. And the Aam Aadmi is impatient. All eyes are on Budget 2016. This isn't just another budget. This is the time to deliver. The time is now.
On the one side, there should be some amount of opening up of the medical education where the private sector can be participating in a very open and a transparent manner, which is currently not the case. Secondly, I would say that we need to be able to make sure we are able to take investments down to Tier 2, Tier 3 and Tier 4 cities. But net-net, as a sector, there's a lot to be done, and I would certainly keep service taxes and those matters out of the debate at this point in time. We have a lot to do. We provide high-value care at a very affordable point, and the industry needs to be able to focus to do that.
The true reforms are those which result in transformation in the lives of citizens. As I have said before, my goal is reform to transform.
I think it's important that the government makes a very serious thrust on high-quality infrastructure. So I'm sure it's always a balancing act between maintaining the fisc and spending on infrastructure. But I think that is a very important push required in terms of setting in place a virtuous cycle for the whole economy. And one hopes that corporate tax rate will come down as well.
For a country in the modern day, it is not sufficient that its economic policies should only address its domestic priority. To me, India's policies must be such that they make a positive contribution to the rest of the world.
I think it's important that the government makes a very serious thrust on high quality infrastructure. So I'm sure it's always a balancing act between maintaining the fisc and spending on it.
GDP is quite low, and I think corporate profitability, which is at a cyclical low, will start improving. And I think next 3-5 years the profit growth should be above trend.
But where is the profit growth? Or where is growth rather?
I think we are in a transition and consumption is slowing down, and I think the slowdown in consumption is because of a number of reasons. One is the penetration levels of lot of consumer staples have gone up, and therefore in future I think we will see less volume growth, and that is a longer term trend. Inflation again impacts, low inflation again takes away growth for a lot of consumer staple companies. I think export-led businesses which have grown very well of last few years, they are seeing slowdown because the volume growth again is less and tailwind of currency is not there. So while this segment is slowing down, I think the growth has to come from capital expenditure. And capital expenditure does not revive in quarters, it takes years. But I think there are very good signs in many areas like roads, railways, power T&D, mining, defense. I think a lot is happening, and the operating leverage in businesses around these, I think, will play out extremely well over the next few years, and that is what should drive growth.
Naren, in any financial market there are two types of risks. Number one is the valuation risk, and then there is the emotional risk. How would you map the valuation risk for us and the emotional risk? Because what's going on in the world is not just valuation, it's about emotions, it's about human behavior, it is about compulsion, it is also about adjustment, like Howard Marks said.
The emotion risk part of it is pretty easy. Everything is flashing that you have to be buying. If you look at the situation, you neither have FII buying, and even mutual fund inflows are lower than where they were last year. At least they are still reasonably positive. So I think on the emotional side, the best indicator is go and watch TV channels or go and see newspapers. Look at the first page, you know where you are on the emotion quotient. And look at the headlines we used to have in 2007. So I think the emotional risk part of it is clearly telling you this is a time to buy and you have to keep buying while the headlines continue to be bad. So that part of it is easy. On the valuation side, what happens is there are pockets which are still not as cheap as they were, let's say in 2002 or 2008 or even 2011, for example. Some of the mid caps are still not as cheap as they were in 2011. So from a valuation standpoint, where there's been savage selling has been where FIs have held a lot of shares and they found that they have to sell them. So those areas have corrected to extremely attractive levels. But there are areas like, for example, MNCs, some of the what we call quality at any price stocks. These stocks have started to correct, but they have been meaningfully corrected. So if you look at the last 3 years, 5 years returns in some of these stocks, these are outstanding. And if you see, bulk of the returns have come out of price to earnings expansion. So on the valuation side, large caps are clearly cheap. I think small caps after this correction have become cheap. But there are pockets which are still not that cheap.
So watch TV channels and gauge the market mood. Me and my colleagues have been quite bullish on ET now. We've been telling our viewers that buy if you're a genuine long-term investor. So if the TV channels are bullish, maybe it's not time to be bullish.
No, TV channels can also be right sometimes.
Well, Nilesh Shah has a history of getting it more right, less wrong. And Nilesh, let's go back to the global factor, the 3 C's, China, currency and commodities. Pick up the strongest C for us.
I think the strongest point is China. We all thought in the middle of 2015 that if China falters, people will view India positively and bring more money to us. Unfortunately, today we are paying the price of going down with China. The global emerging market funds have received redemptions of about $250 billion between 2013, 14 and 15. This includes debt as well as equity. Let's assume that 100 was equity and 150 was debt. So India allocation at 10 to 14% would have resulted into 10 to 14 billion dollar of outflows. Net, we have actually received inflows during that period. So effectively, if you see, we are receiving flows, but right now because of China pulling down the emerging market indices, we are actually seeing outflows. A time will come when people will start differentiating India vis-a-vis China. And hopefully when that risk-on trade begins, we should be able to get more flows into our country.
Nilkant, in 2013-14, we secretly prayed that crude should go down and that would be beginning of a new dawn for Indian markets. From last 1 month, all of us are praying that crude should go up and Indian markets will stabilize. So what is the correlation with crude? Where do we want crude? Go up or down?
For the economy, as a citizen, you want low crude. But for the markets, I think if you just look back the last 20 years, plot Nifty and oil, there are long periods of positive correlation. There are a few periods of no correlation. There is no period of negative correlation. So what crude indicates is, one, of course, the capital flows, because the savings of oil companies, oil countries were coming back to us. It also shows the global risk appetite on what's happening to growth. And what is, I think, less well understood, that our larger indices, Nifty, BSE 100, are actually more about the world than they are about India. So I personally think that the Indian economy is reviving very strongly. I mean, you do not see 27% year-on-year growth in bitumen. You don't see double-digit growth in oil demand volumes. You don't see cement volumes picking up. You don't see credit growth picking up. I mean, we are in such state of depression that when liquidity tightens, we start blaming the RBI's intervention or some state government borrowing. The reality is that credit demand is picking up. After 15 months of below trend, credit growth is as per seasonal. It's a good sign, and we want to ascribe bad reasons to it. And I think I agree that I think sentiment is perhaps as bad as it gets. There will still be concerns about global selling. I don't think we are done yet. I think global volatility will continue. But so long as you're exposed to Indian fundamentals, I think the stocks and sectors look very cheap.
Pradham, historically, every time markets have corrected sharply, like the way they've corrected this year, they've always corrected after an economic event. Whether it is after the Bear Stearns crisis or Lehman Brothers, whether it's happened after the TMT, dot-com bubble in 2000. Right now, there is no large economic event which has surfaced up in 2016. China is yesterday's story. The fact that commodity prices have come down is 2015 trend. So what is the panic all about? And what are markets so nervous about?
No, I think there was an economic event. It happened in December when the Fed hiked rates. And I think the market took a view that the Fed has probably erred because there is a lot of pressure from global sources on the US economy. Mind you, the Fed was reacting to falling unemployment in the US and rising wage growth in America. And if you look at the Fed models, it's probably justified. But the market was also taking the dollar up. And the dollar on a trade-weighted basis, and I'm not referring to the DXY here, is up a lot. And it translates into almost 100 basis points of tightening for the US economy. So in fact, I would say it's not about the 3 C's. What has happened in 2016 is about what the market believes is the case with the Fed, which is that the Fed is probably caught between a rock and a hard place. While it realizes that the US economy is strong enough for higher interest rates, there is still global pressure on the US, and that warrants probably a dovish Fed. And they are in that position, and the markets, I think, have responded by taking the US dollar higher and by basically taking markets down. So I think that was the problem so far. I think we have seen that adjustment. I concur with Narendra. If you look at the emotional factors in the market, I have a full house buy signal on sentiment. So we have a proprietary sentiment indicator. It's only the 9th time in 15 years that we have a full house buy signal. If you can go back December 11, end of 2008, 2003, 2001, those are the instances, and in the middle 04 and 06. These are the only instances when our sentiment indicator has given such a strong buy signal. So the emotional factor is clearly in favor of buying the markets. Valuations, again, going back to Prashant's point, we recognize the fact that earnings are depressed. So a better way of looking at valuations is to look at the Schiller P. And the Schiller P in India today is at all-time lows. If you go back in time, you've never lost money on equities in India buying it at such Schiller P levels with a one-year view. So I think India bore the brunt of being a high-quality market in an otherwise very challenged world and was almost like the last man standing which got knocked. A lot of emerging markets put their bottom 2 weeks ago. I think India probably has put its bottom. I'm saying this with great caution because short-term calls is not my forte, but I think we put the bottom last week. So it's certainly time to be long equities. But of course, not to take away the fact that the world is still a challenged place. So we'll keep getting corrections along the way.
So Prashant is bullish, Naren is not selling, Nilesh is not selling, Neelkant is not advising his clients to sell, Rhythm is bullish, Nagnath has the same view. So maal bech kaun raha hai bhai? Who's selling? Rhythm?
So I think we have seen a lot of emerging market outflows over the past year or so. In fact, the equity outflows are now closing in on $90 billion alone, only equities. India has not seen that much of selling. Investors, foreign investors have been overweight India, massively overweight. So some of that positioning has got lightened because the outflows continue in EM markets, and EM markets, a lot of them have got fundamental problems. So I think that's one. But I wouldn't really worry about who's selling, Nikunj, because it's not about who's selling. It's just that there are no buyers. It's a buyer strike. It's not actually that we are seeing massive selling in the market. It's that people don't want to bid share prices right now. So once the buyer strike ends, and it usually ends when stock prices start rising, you'll see that the selling would have easily ebbed.
I was looking for that answer, that there is a complete disbalance between the buying and the selling equation. Nobody wants to buy, everybody wants to sell. Nagnath, this question is coming your way. And you know, one question which sort of is puzzling a lot of investors is that great macro somehow has not translated into great earnings. 2013 was a very poor year for macro. Stock markets did well, earnings were reasonably okay. 2015 has been perhaps the most encouraging macro year for Indian economy, yet that has not translated into the earnings momentum.
So I think to answer that, as we look into fiscal 17, you know, while we've had low single-digit earnings growth for fiscal 16 and fiscal 15, I'm quite confident that we'll see around 15% earnings growth for fiscal 17. And my belief is that this will be simply because of all the factors that the panelists mentioned in terms of improvement in the economy, the strong macros that we have currently and we will see again in fiscal 17. But more importantly, from an earnings point of view, whatever downgrades had to happen, I think have happened. So whether it's commodity companies' earnings being downgraded, I think we've hit a bottom there. From here on, it has to be either static to maybe, you know, earnings upgrades. If you look at the banks in terms of the NPLs that they've provided for, I think, you know, another quarter or two, and then after that, the intensity of the hit to earnings will be much less. The benefit of lower commodity prices filtering into the earnings of the commodity consumers, I think, is not yet fully visible, which I think will be visible as we get into fiscal 17. And then the fact that we've had poor consumption demand because of two suboptimal monsoons, we think this year, that is fiscal 17, the rains will be normal. That's an assumption I'm making. And based on that, if rural demand picks up, I think consumer companies also will see an improvement. So if you factor all these three, I think you will see nice double-digit earnings growth, which will then, you know, to your question, the micros will also begin to look as good as the macros.
Nagnath, let me come to the moot point, and the moot point clearly is that we are about 1 week away from the budget. Typically, before budget, we use the term pre-budget rally. For the first time in many years, I'm using the word pre-budget nervousness. Markets are confused, no one knows what will happen to the taxation structure. In general, there is no participation. This week, India has been volatile, but globally things are looking up because there is nervousness. So what is the importance of this year's budget? And what can happen in this budget which could change the trajectory, both for the economy and for the markets?
Well, I think as far as the budget is concerned, I'm expecting it to be a budget that spurs growth. And to that extent, I would be very bullish on it. As far as the market cues are concerned, I think they are reacting more to external factors. We've had a very volatile, January. My own sense is globally things will settle down now. I think central banks and policymakers around the world are going to use all the tools at their disposal to ensure that they soothe the market sentiment and investor sentiment. So that, should ensure a stable to an uptrend in the global markets, I believe, in the next 2 or 3 months. Maybe in the summer again, you will have the markets once again focusing on the fact that there is a general growth slowdown around the world, but that's for later. I think for the next few months, I expect the volatility globally to subside. And here also I expect a good budget. So all put together, I'm expecting the uptrend to continue into the next few months.
There is a lot of debate and perhaps argument on what is the prudent strategy in this kind of an environment. Look at fisc, or government should actually forget the fisc, at least for the moment, and increase commitment towards expenditure.
No, Nikunj, I think continuing on the path of fiscal consolidation is imperative. It has generated substantial reward for India. India is being viewed globally as one of those emerging markets that have started fixing structural problems. The RBI did its bit by taking real rates into positive territory. The government has done its bit by consolidating the fisc. I don't see any reason to abandon that path. Within the government's expenditure, there is still scope to rationalize subsidies, to rationalize expenditures that are not important, and to focus on investment spending. So I think there is scope to move those things around. The government did part of it last year and will probably continue to do it this year. But I don't think I would recommend that they abandon the path of fiscal consolidation. I know there is chit-chat about going for a more aggressive fiscal deficit. That I think will be viewed a bit more dimly by foreign investors. I think this is not an opportune time to do it. The world has got a problem, and I don't think we should do that.
But my counter argument to that, Rhythm, would be that ultimately markets, they want growth. Do global investors frankly care for a fiscal deficit moving from 3.3 to 3.6, or for that matter 3.8?
No, see, as Neelkant has pointed out, growth is coming back. The problem we have is slightly different, which is that we don't have earnings growth. And the reason why we don't have earnings growth is because of persistent PPI deflation, not because we have poor real growth. You see, if you look at the last decade or so, India averaged 12 or 13% nominal growth. Today, India's nominal growth is 7%. And that's the context for earnings. So we have to fix PPI deflation. That's not something that the budget deficit can do. If you let the rupee go a little bit, and the rupee on the RBI's real effective exchange rate model is 6-7% overvalued, automatically the PPI deflation stress that is there in the system will start ebbing, and that will take care of the earnings problem. So I would actually isolate that as the single largest problem. Now, of course, this doesn't mean that the government doesn't, say for example, I would strongly urge the government to consider a big recap of the public sector banks. That I think will probably help growth a lot more than undertaking some scattered spending in the budget.
So, Neelkant, let me take a cue from Rhythm's last line, which is recap of public sector banks. The committed numbers right now look like pocket change. 60-70,000 crore, that's not going to cut ice. What can this budget do to fix PSU banks? And if nothing comes out in this budget in terms of a large commitment towards PSBs, what happens there?
No, I think before the recap number can be finalized, we need to understand how big is the hole that will get created once all the bad loans are provisioned for adequately. And I don't think we have clarity there. I don't think there is clarity among policymakers on what should we do. I mean, I can clearly see there is a sense of urgency that needs to be resolved. I think there is a lack of clarity on how exactly to go about doing that. And till we know the number of 25,000 crores for next year, I don't think is going to go up. So I'm personally not expecting a big number to come up in the budget. That 25 is now become 40. Even if it becomes 40, till you really know how much loss is really sitting there and which are the banks that will need that capital, I don't think the market will really respond too much just to that. I also think that the nature of spending and how it is to be funded, if the government ramps up expenditure and also ramps up taxes, so then the fiscal impact is actually zero, right? If the disinvestment, and which I think this year has been the biggest disappointment, if the government is able to find funds outside of taxation and then use it for growth stimulating expenditure, that would be a very positive development for me.
Nilesh, what could be that big idea? Because frankly, the options are limited. It's difficult to divest or sell government stake in a commodity company in this kind of an environment. So SAIL or ONGC, IOC, that's a difficult proposition to sell. The crude lottery, I'm using the word lottery on purpose, will not be applicable in next financial year. So the finance minister will have to come out with something innovative, more like a out-of-box big idea.
So there are various ways which can be used to, fund growth. The simplest one be that instead of depending upon borrowing or instead of raising taxes, we should try to monetize our assets. Now you cannot divest a public sector undertaking, but you can divest your stake in SUTI kind of thing. You can divest your stake in Hindustan Zinc kind of thing. Now let's look at Hindustan Zinc. When government divested it for 51%, it was at 350 crore. The quarterly profit of Hindustan Zinc in today's world is 2,000 crores. Can we think of divesting certain companies like that in the hands of private sector, which can then, make better use out of it? The second thing is related to, our wastage of money on gold imports. We are spending on an average $22 billion every year for import of gold. Now let's put 2% wealth tax on gold held by above a certain minimum level on everyone, including religious institutions. If they put that gold into gold monetization scheme, give them exemption on wealth tax. Straightway you are creating revenue out of wealth tax. On the other hand, you are creating a powerful inducement for them to park with their gold, put it into gold monetization scheme, and bring that gold into domestic recycling. If you can save that $22 billion wastage every year, probably that's equivalent to bringing all the FII inflows in a good year. The third thing is related to black money. We all know the maximum black money is in real estate economy and in gold. Now, in gold, all the jewelers, if you see, they have a video recording. Go and catch their last 6 months video recording. Find out who have paid cash to buy gold. Go after them, bring them into TaxNet. Your problems will get solved. The second thing is real estate.
That's an innovative and a big idea.
Oh, lots of innovation. Or you can call it jugaad also. On the real estate, many years back we had a fantastic law. It allowed government to take over any property which was underdeclared, undervalued, below 75 lakh rupee. And that in the initial year resulted into almost all transactions becoming full white. And then over a period of time, my hypothesis is that some of the guys did a jugaad over there, whereby they started selling overvalued property to the government and ensured that that law was removed. Now, government is not the best person to handle that kind of law. Give it to a private agency, give it on a profit-sharing basis, allow them the authority to pick up any property which they believe is undervalued, to buy at their cost and sell it into the market, and if they make profit, share it with the government. If you do that kind of innovation, trust me, the real estate black money problems will be to a great extent reduced. Moment that cash starts coming into overall economy, we will see growth coming back. You want to hear more?
No, I want to share something with the audience here. When you're in your 30s, there are two words you dread, and some of my married friends would agree with me. The first four-letter word is wife. The second is boss. And from a market standpoint, the four-letter word which is bothering everyone is LTTC, long-term capital tax. Everyone, Naren, is really concerned, bothered, worried, and is desperate to know that what will be the impact if the tax on long-term capital gains comes back.
I think it's a very difficult question to answer. So, I'll only talk about the debt experience. If you see the debt experience, suddenly 1 year we shifted from 1 year to 3 years. So initially people believed that, the debt mutual funds will become obsolete, no one will invest in debt mutual funds, etc., etc. But and here if you look at in debt, there is a dichotomy. If you invest in a debt security, the long-term capital gains tax is applicable after 1 year. And if you invest in a debt mutual fund, long-term capital gains tax is applicable after 3 years. These kind of dichotomies, I think, have created more problems let's say, in debt mutual fund, that if you invest in, why should it be that if you invest directly in a debt security, your long-term capital gains tax should be 1 year? So I think these kind of issues are a bigger problem. We have, what people don't realize is that in the last 2 years, from having a subsidy of more than 5 rupees per litre on diesel, now we have a excise duty of 17 rupees per litre. So you're talking of a 22 rupees shift in excise duty just on diesel. We consume 9,000 crore litres or something like that. So, we get almost 1,50,000 crores extra excise duty just from diesel. And this whole debate is on fiscal deficit. But if you look at it, right now the fixed income market doesn't realize that if Uday scheme happens, whatever debt is issued by state government, that money will be coming back to banks. People don't look at that part. If you look at if banks are going to be capitalized by 70,000 crores, that money is again available in the economy. Let's say they capitalized by 1 lakh crores. So right now, there is just too much of debate on fiscal deficit. When we look at 12-month rolling fiscal deficit at this point of time, I think we are at our lowest number in the last many years, and maybe once before it has happened, like similar number. So I think this whole debate on taxation, lack of money for capitalizing banks, all these are not issues at this point of time, because if you are able to generate growth, automatically taxes increase. You got a bonanza of $75 billion due to crude oil. So I think tax is not an issue. Growth is an issue at this point of time. If the government, like Arundhati Bhattacharya rightly pointed out, the growth has to be kick-started by the government. People are not going to kickstart the government. Corporates are in no position to kickstart growth. So I think we have much more of growth issues. We have much more of no fiscal deficit issues. Somehow we have to engineer growth in the next 1 year, because if that starts in the next 1 year, I think automatically then people start growth, then corporates start growth. Today capacity utilization is at 70%. If it goes back to 85%, a capex cycle starts. No one asks why should there be a capex cycle today if cement capacity utilization is low, if steel capacity utilization is low. Across sectors you have capacity utilization low. You can't create a capex cycle. So I think the problem is right now growth. There is no other problem in the economy, and government has to kickstart growth.
At this point in time, I also want to encourage the audience to start thinking of some questions. You can send me a chat, but don't sit on your hands. We'll open the floor in about 20 minutes for some Q&A. Prashant? Yes, please.
One point. You mentioned that the benefits of oil are behind us. They're not. So because oil demand is growing in double digits, so even if you assume 8% growth for next year, and you assume that excise per litre stays the same, we're talking about nearly 73,000 crores of additional excise revenue next year.
But, Nilkant, that's the macro kicker which may be missing next year from the overall maths.
No, that's the math I'm talking about. So if excise, you will get 73,000 crores of more excise than you got this year.
Yes, logically, yes. Prashant, the moot point is budget. What is the importance of this year's budget from a market standpoint? Markets are nervous. Can the budget 2016 do the trick?
I think it would be wrong to link budgets and markets. I mean, that's what I feel, and I think this...
You'll get me out of business, sir. You'll get me out of business.
Not out of business, but I think it's just, people will still watch, but I think we should not link budgets to markets. But I agree with that points made earlier. I don't think fiscal is under so much stress as is made out to be. Because current year, the excise on petrol, diesel has gone up through the year. And next year you will get the benefit of that for the entire year, plus the volume growth what Nilkant was mentioning. So I think the revenue side is pretty good. Service tax rates will go up. I think And the capex will revive not from the manufacturing sector. I think that is known because capacity utilization is low. But the capex push and signs are coming from roads, railways, T&D, mining. And I think bulk of that is directly or indirectly funded by the government. I think last year there was a good increase in allocation towards capex. I think next year again there should be. And let us not forget that there are a lot of entities in the system like NHAI, like the SEBs. I mean, you look at the health of SEBs from April onwards, I think we are in for some serious, pleasant surprises. I think the lot of power utilities in the public sector space, they are sitting on net cash balance sheets. So I think in these areas there is no dearth of cash. So I think I would simply look at whether the process which was begun last year to reviving the capex in these 4 or 5 areas, how aggressively that is carried forward.
Prashant, what is your take on how markets are prepared for any change in taxation structure? I mean, taxation changes should be done when the going is good, not when the going is rough.
I think, yes, it can lead to a knee-jerk reaction, but I don't think it will decide the market level even 6 months from today. So I think that's how I look at it. 1 year from today, markets will be decided entirely by either by sentiment or by how earnings play out.
Naren, a couple of days ago, I was watching an old Hindi movie on cable, Damani, and Sunny Deol made a strong dialogue. Tariq pe tariq, tariq pe tariq. I get a sense about earnings. Every quarter we say, this is the burst quarter of earnings, then next quarter we say one more quarter of earnings. We start the year with a 10-12% expectation and then we scale it down. And I don't know how many of my friends would agree here, but that's been my personal experience. Tariq pe tariq, tariq pe tariq.
Basically, as Neelkant mentioned, so much of
No, don't blame it on Neelkant. Everybody has this view that earnings will recover.
So much. In fact, I've come up with a model which basically I believe if everyone is going to wait for earnings to come, that year on year 20%, they would have missed investing in this market. Earnings will come, let's say commodity prices go up, you're going to see earnings come back. Are you going to wait for see, if you look at the last 3 years, the best returns were made in the pre-election phase. The returns were not made in the post-election phase. If you go back to 2009, returns were made in the pre-election phase. So I think, if you look at the recent RBI cuts, if you had invested after the RBI cuts in any duration, fixed income, mutual fund, you wouldn't have made money. So I think equity investing is about investing when you think earnings will come later. And if you're going to wait for all the certainty, I think you miss the safest part of the bull market. And I think clearly, as Neelkant pointed out, too much of our earnings comes from commodities. Too much of our earnings comes from factors which cannot be, no one predicted $30 oil. So if you look at $30 oil, so much of our earnings have come down. The benefit is hitting in this 20 rupee change in excise duty on diesel. Are people looking at the earnings of the government of India? They are looking at only the corporate sector. So I think, the earnings of government of India finally belong to the earnings of the country. So I think that part of it, the improvement in fiscal deficit, the improvement in revenue deficit, the improvement in our foreign currency position, the kind of cushion that RBI has created in foreign currency, all these things are not being factored in. So I think we can't wait for earnings. This is the year to invest. As you mentioned, as people mentioned, we don't know the bottom. At least Rhythm mentioned last week is the bottom. We don't know that's the bottom. Clearly, people should have invested at least 2 out of their 12 installments by now. And then keep investing if the market continues to correct. The opportunity is there clearly for money to be made for people who invest in equity this year. And that opportunity you have to make use of.
So, Naren, if I write a check to you, I'm carrying my checkbook actually because I wanted to do this. 3 years post-dated, what could be the targeted return?
I think, did people expect...
3 years.
See, I think it's clearly equities is one of the best asset classes. We have mentioned that this is the time to go marginally overweight equity, and by the end of the year, you have to be fully overweight equity. What returns you get, that I think virtually no one is able to predict. So why make a prediction on something? Did anyone expect 23,000 this year? And if I had given the entire audience a number, Brent at $30, and told them what will be the Sensex, I can guarantee no one would have come up with a number of 23,000. So I think these kind of things are difficult to predict, but clearly it is time to put money in equity. The opportunity is there. The reason is because of Sovereign Wealth Fund and the Emerging Market Fund wants to sell. Is he selling because of the fundamental problems in India? Certainly no. They have to sell. They are forced sellers. You get an opportunity due to forced selling. Use that opportunity.
Okay, fair point. Nagnath, this question is coming your way, and walk us through the margin of safety. For a long-term investor, there are two things which matter. What are you buying, and at what price are you buying?
What are you buying, meaning?
Where are you investing, and at what price are you investing, which is a function of margin of safety and valuations?
I think for mutual funds, you're pretty much fully invested most of the time. I mean, the cash levels are typically anywhere between 3 and 5%. So in that sense, you're fully invested. You get inflows, you invest it. If you have redemptions, you sell. So there are no cash calls that are actively taken, as you can well imagine, in mutual funds. As far as the trend is concerned, I would agree with what the panelists are saying. As we look into fiscal 18 and beyond, I think the growth momentum would have gathered substantive pace, is my view. You have to invest in anticipation of that upturn in earnings, which I'm very confident will come in fiscal 17 and then accelerate as we get into fiscal 18. So in that context, I think, the banking system is a big weightage in any bellwether index. I think after this NPA provisioning is all done, the entire sector should once again do extremely well. And especially, I think PSU banks, if I take a 3-year view, I'm very, very optimistic in terms of price performance. Consumer discretionary, I think on the back of what I think will be a normal monsoon this year, ought to do very well, and that trend again will continue in the fiscal 18, I believe. And then the revival of the capex cycle, while it might take another 12, 18 months, should definitely benefit industrials and capital goods and allied sectors.
Rhythm, let me get your big idea and some closing comments from you as well. For a long-term investor, where things are looking strong, and where do you think sizable returns can be made?
So, you made a point earlier on earnings. BC Forbes had quoted this, that a financial writer was once ridiculed by saying that there is nothing to commend about this company's earnings. And he said that, if you put your money into a well-managed business run by honest people, the result will be good. So I empathize with Narendra's reluctance to give you a 3-year target, because price performance or returns are not absolute. They're all in a relative context. And we really don't know how relative returns will behave over the course of the next 3 years. To me, it seems like a low return world. So we have to unhinge ourselves from trailing returns, which, the Sensex may have given you 16, 17% compounded over the last 20, 30 years. But the world was very different then. And maybe that's not the type of return we will get over the next 15, 20 years. But probably equities will still be the best performing asset class. And keeping that in mind, I think for India, I think you want to back consumption. So I more or less agree with what Nagnath said. I think consumption is likely to be the best place to invest in. I think some of the best managed companies, well-run companies are in the consumption sector. For industrials, I think you need to have better timing, because they have, cycles. But at this moment, I feel industrials look quite attractively valued. I think private banks are still looking good. Some of them have become very cheap in the recent correction and should be looked at. I think the trickiest part is buying global commodities and energy stocks. That's the trickiest bit, because that depends on what happens globally. So I think that's safely avoided. And maybe if you can trade that, if you're a very good trader, then maybe you'll make some money. But I think from an investing perspective, those are probably avoided.
Every time I interact on a public forum, the buy side and the sell side people, they always have the same opinion. Privately, when I speak to them, the opinions differ. I don't know if it's a coincidence or my lack of understanding, but often happens this way.
But as far as this is concerned, you can check his portfolio and my portfolio.
No, I'm not getting into, it's just a common observation that buy and sell guys on a public forum, they talk the same language. We'll debate it again privately, because I know opinions may differ. Let me get some closing comments from you as well. Give us an actionable idea where you think sizable returns could be made.
No, I think in non-banking finance companies, and they are too, not every company, but some of them. I cannot name stocks, there are SEBI regulations. But in the non-banking finance companies, I expect to see continued strong growth. Some of them are also, earlier there used to be this problem that the RBI was unhappy letting the NBFCs grow, but this establishment is not of that view. I continue to think that lending rates will, from the bank side, will fall less. So they will continue to be a spread that they can enjoy. And some of them will also enjoy very good volume growth. So that's why my sector, we have been positive consumption, staples and discretionary for 5 years. I see no reason to change that as well.
Nilesh, apart from innovative way how to monitor gold and how to prevent things on that aspect, what is your other big idea in terms of a theme or a actionable stock idea?
I'm paid to say that you have to invest in Kotak mutual fund schemes. If I dare make any other statement, I'll lose my job. But I want to answer your first question. Where will the Sensex or Nifty be?
I like that answer. Nobody's answering this.
Yeah. So in 2005, Sensex was where today's Nifty is. Right? Do you believe history repeats itself?
Well, it rhymes.
Yes. So probably over next 10, 11 years, Nifty should be where today's Sensex is.
Okay. Let's put our hands to that. I mean, that's the most bullish prediction I've heard. So what will be the number like for Nifty in 10 years?
I was miserable in maths. Naren was great at that.
So Naren, I'm speechless. I don't know how to phrase my next question.
I think if I don't know the percentages, but it's good to give when there's gloom. It's best to give such a forward-looking statement.
Where is gloom? All six of you are bullish.
No, but finally it depends on the amount of AUM that people give me, and people are not willing to invest what they were willing to invest in 2015.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.